Let's review where we are in the investment decision-making process. This is the exact same slide we looked at the start of the 101 course. So our ultimate goal is to make investment decisions, which are typically made using professional materials like an investment memo, or we can call it a pitch book, or we sometimes call it teasers. Whatever we call it, they are polished documents prepared in PowerPoint or in Microsoft Word. For significant investments, such as large M&A deals, these materials are almost always going to be used. And before reaching this stage, what we have to do is valuations. So the final investment conclusions presented in the investment memo are usually derived using various valuation methodologies such as DCF, trading comps and transaction comps, or LBO, which we're going to learn in this 201 course. These valuations, they require financial projections. They are essential before any valuation work. So we need to thoroughly estimate the company's future revenues, expenses, cash flow, balance sheet items for the coming years. And furthermore, these financial projections are not done arbitrarily. They, as we now know from our experience in Financial Modeling 101, they require a detailed and accurate analysis of historical financial data. So in summary, we analyze the historical street statements. We use these to make financial projections. We base our valuations on those projections, and then create an investment memo, and we reach investment conclusions. So this process constitutes the investment decision-making process. In our 101 course, we focused on learning financial analysis and projections. And in the upcoming 201 courses, we will dive into valuation. So this part over here, particularly, we're going to focus on the three main valuation methods: DCF, trading comps, and transaction comps. And for those of you who are proceeding to Financial Modeling 301, 401, or some of you are listening for the technical interview course, we are going to explore an in-depth version of this entire process and gain a deeper understanding of modeling and the investment decision making. And finally, for those of you who are going to take the PowerPoint Essentials course, you'll learn how to create polished materials and develop storytelling skills for presenting your analyses effectively. Now let's begin studying the methods of valuation, also known as corporate value assessment. So on the right, we're looking at a framework that I've personally created. One of the most frequently asked questions when teaching valuation is whether performing a valuation guarantees investment success. People often ask if I use perfect assumptions from the 101 course and apply flawless valuation methods and assumptions from the 201 course, can I guarantee a successful investment? Well, as most of you already probably know, the answer, to put it simply, is partially yes. Conducting valuation does not always, result in a successful investment, but it does increase the likelihood of making a successful investment. For an investment to succeed, two key factors must align. So the first is the fundamental quality of the company. So this means the company's financial statements, valuation figures, things like those. So things that we're learning from this financial modeling and financial analysis courses. But no matter how strong a company fundamentals are, if there is no momentum such as market interest or market attention, or if other external factors do not align, the stock prices may fail to rise. So the intrinsic value of a company might be strong, but how much of that value is reflected in the market depends on the specific circumstances. So we are currently focusing on fundamental analysis, and we're learning to assess a company's true value. However, unfortunately, we do not cover the momentum aspect, as we are not, professionals in that area. So even if you excel at fundamental analysis, we might not achieve successful investment if momentum does not align. So looking at this table, it's pretty clear that if both fundamentals and momentum, if those both are strong, we should probably invest in that target. It's a no-brainer. However, what if the fundamentals are excellent, but the market interest and external factors seem weak? In such cases, the best approach is to buy and then wait. We hold on to the investment and wait for the momentum to catch up. Of course, if you have exceptional skills or luck, you might be able to time your purchase perfectly, but that's not easy. That is why fundamental analysis is not only useful for short-term investments, but is even more impactful for long-term investments, where time allows the intrinsic value to be realized. On the other hand, there are cases where a company with poor fundamentals, what we sometimes call junk stocks, experiences a soaring stock price. This happens when momentum is strong, even when the fundamentals are weak. In such situations, the common advice is to treat these as opportunities for short-term investments. Capitalizing on momentum while it lasts can be a rational decision, but these investments typically lack stability in the long term. So, where is the demand for fundamental analysis and valuation the highest? We can say that number one, it's in M&A. So when conducting M&A, we put in extensive effort to analyze, project, and perform valuations. This is because M&A typically involves long-term investments, and the assumption is that momentum will eventually catch up. This is especially true for investments made by private equity firms, where the focus is usually long-term value realization, maybe up to 3 to 5 years. And this is why we dedicate so much effort to mastering these skills to effectively operate within this critical area of investment. Lastly, fundamental analysis, it's not only important for making investments, but it's also very important for raising investments. So raising capital for funds. Or maybe if it's a large corporation or if you're running a startup, you have to thoroughly analyze your own company, and we have to craft a compelling story in order to make a successful funding. If we have the correct analysis of our fundamentals, it's going to enable effective communication with investors, and it's going to definitely help secure investments under favorable terms, because we're demonstrating with very good logic high corporate value. So this is why many participants in our course come from even corporate management, strategy teams, finance teams, investor relations, and so on. So now that's it for our intro to the investment decisions. Now let's begin learning about valuation. However, before diving right into valuation, We'll first go over some of the essential background knowledge that will help you better understand the valuation concepts. So let's get started.